Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Tuesday, and we are now on the 17th of July, 2018, pushing 2:45 p.m. Central Daylight Time. You know, President spoke today. We had Fed Chair Powell. He was grilled. The old Humphrey Hawkins, they don't say that anymore. They say it's going to the Finance Committee. It's what it used to be called. And you can see how the stock market likes everything it's heard. It even liked when the president said, he didn't mean the word would, he meant wouldn't, and he forgot the double negative. He went on with that and tried to clarify it. It's interesting because he's got the Russians won over on one hand, at least some of them, and now he can win back the Americans on another hand, and he's made it clear that it was the word wouldn't, and I think that was important, and hopefully it's behind them. As you can see, you're getting something of a bounce in the grain market. Now, the markets act like markets that they had gone down so far, so much, that everything in time gets a bounce and a reprieve, and I think you're seeing it here. I think you're seeing it in the cotton market. You're seeing energies pretty flat in the water, really not going anywhere at this point in time. The dollar, let me come right here, is up 45 points, looking good because the Fed today, again, reiterated. They're going slow, but they're going to raise the interest rates. And they're addressing the growth, the inflation, and they're addressing the trade issues. And that has put down most of the foreign currencies against it. It doesn't do an awful lot for our farmers, which are still on the front wave of taking the chin blow off the trade tariffs. But if you take a look, the market for a change, even after this monster decline of $2, at least for the first 2 days of the week, we're up 25.5 cents in the soybean market. And you can see how the market over the past 2 days has at least stopped its decline. That does not mean it's bullish. It has stopped its decline. That's all that it means. I use a study called swing lines to tell me what the trend is doing. This is the chart without it. This is it with it. And I can see I have a higher high and a lower low, which is not a trend. I then run moving averages. Now, I run more than the averages you're seeing here. If you take my charting course or one of my subscriptions to my research, you're going to see I use different moving averages. Not different than these. They're included, but others with it. This is what I call the red line, the 18-day moving average of closes, the line in the sand. From that, I have either got a bearish bias if prices are under it, a bullish bias if they're over it. If prices are under the market and they rally, I am looking for that 18-day average to become resistance. If the market is over it on the first challenge, I'm expecting support or I'm expecting resistance back up to it. Do you understand that? I really teach it in great detail in my charting course. But in any case, on this current rally, it will not surprise me to see prices get back to the 18-day average, which is currently 873. Where did the market hold? It held on the lower Bollinger Band. And let's remember what Bollinger Bands are. They're an algorithm that is designed to keep the market trading within the black bands 95% of the time. That means 5% of the time the market can step out of the band the way that it did here. But if you go back and you look how often they stay within it, it's almost saying to you, hey, don't get nuts in the head and start selling the low of a big breakout on. It doesn't mean it can't ultimately go lower like it did there. That's not what it's saying. What it's saying is you might have an opportunity within the band to do it. Now, sometimes you ride the band down. Riding it does not mean stepping out of it. You can be one day out, next day in. That's riding the band. So there's a lot to learn with it, but it's a neat theory, and it's become one of the mainstays that I look at in trading. And then another part that I use, and I know traders use MACD, relative strength, slow stochastics, whatever you want to call them. They all have these fancy names, but they're all one thing: momentum oscillators of some type. That's what they are. And I like the crossover that slow stochastics do, but I like something else about them. When a slow stochastic reading has both numbers under 20 for several days or more in a row, and just like here, you still have it on Monday, and you lose that reading, the odds favor you've lost the downside momentum and prices going back or make a run back, try to the 18-day average of closes, that line in the sand. If the market's going to re-embed, the only time it can do it immediately, and I use the word immediate, is the next day. So when you get a market that closes, I'll give you a tip on that, near the highs of a day, and we're closed now and you've lost it, it's very difficult to re-embed. If the market were to have closed near the lows of today, even though it lost it, it's much easier to get it back. Those are the little tricks, and you'll see that over time if you take my course and you become a student with it. So right now, what I'm expecting, doesn't mean it will happen, is prices to make a run for the 18-day average to try to figure out what to do next. This all happened in a different way in the meal market. Meal had lost its embedded reading way back over here. And it got to the 18-day average. Notice how it stopped there. That's that idea that I have. Then it just sort of went sideways in an oversold condition, never re-embedded. Came down, did not put both numbers under 20. This was last Friday, the 13th. Now both numbers are back over 20 or just oversold. And notice where it's fighting, the 18-day average of closes. But when you lost the momentum here, that pretty much ended that leg of the downtrend that had been in place all this time. And you're always looking, if you can, to get an edge. You don't need the last penny in a market. Waiting for an exact number, waiting for an exact event, why? When I look at soybean oil, I am still very much in the bear camp. Lower highs, lower lows. How many days do we have under 20? Well, both numbers were under 20 today and yesterday, but not the day before. So I just have an oversold condition that is riding the Bollinger Band in a downtrend. Certainly the other markets are more interesting on the upside. This one, even selling, it's hard because it's still oversold. In the corn market, you, number one, are not embedded. You're a complete oversold condition. The market has hit on numerous times that lower Bollinger Band, and from it, you've gone sideways each time, often making a run, but so far none of them hitting the 18-day average of closes since way back here at the beginning of June. So hitting it would just give me an idea that, that we finally got to a value area and maybe the market's going to restructure itself. Is there a reason to be long? Well, the way that I teach charting, no. While the swing line is up, my bias is down because I'm under the 18-day average of closes. In the wheat market, I have a pattern of a lower low and a higher high. The first thing I have is no trend. The second, I'm looking at how the market 3 days in a row has played around the 18-day average of closes, looking to see what to do next. If the market rallies from here, I'd expect resistance 513 to 516. If the market drops, I'm looking for the 494 area to be a support zone as it plays around that 18-day average. Could it get back to the lower Bollinger Band? Yeah. In fact, it can reinstate a bear trend by just taking out today's low of 487 3/4, because you'd end up with lower highs, lower lows, assuming you closed lower on the day. Got it? Now, in the sugar market, we had that outside day up and we're stalling. To me, the most important thing on this chart is not the outside day up. It's this embedded reading. Until that is lost, I consider all the other parts, even though it's still a downtrend, noise. This bounce, noise, not that. I still see the trend is down, willing sellers on rallies until that momentum gets back over a 20 reading. In the coffee market, I see a downtrend that has hit the lower Bollinger Band again, and because it's oversold, I'm expecting that we're not getting aggressive new selling in the market. Trend, though, is down. Cocoa market went from a rather dramatic high made yesterday. In fact, if I take out the day before, you first went up, hit the 100-day average lower Bollinger Band, came down to the lower band. You wiped out any trend, but now you're staying within the band. Today you drop again, you finish at 23.95, which is just over that band again. So you're not trending, you're playing on the side of the band to see if you can get follow through. You're still not in oversold condition. In the cotton, the question is, with an uptrend, will you get to the upper Bollinger Band and run into some resistance? I would expect it because the momentum in the market is overbought. In the cattle market, you turned the trend of the market up yesterday. Now, at that point, what you did is you had this in place on Friday. Actually, lower highs, it could be the argument. Then you came up, took out that high yesterday, so you've got higher lows, higher highs, which puts the upper Bollinger Band as a potential resistance and support back at the 18 and the 100-day average of closes, trend up. In the feeder cattle, trend up, higher lows, higher highs, support back at the 150, let's call it 150.07.5 area, but the market is overbought, not looking as good as the cattle. And in the hog market, still very much a bear trend at work with an embedded reading riding the lower Bollinger Band. It got 2 days under, it moved to the right-hand side, still diving. As long as that stays in place, I contend that the bears try to control the market. And we teach a lot of this with our good friends from Futures Magazine and Modern Trader that helped us put together this fabulous primers. It's actually volumes 1 and 2, everything from money management to understanding oscillators, how you work with everything. We've done them in 2 PDFs. They come to you as an email. Lot to learn. Simply give us a call. You can go to our website, sign up for them. We'll have them in the mail to you 1, 2, 3. I'm talking email, of course. Or you can click up here on YouTube. That'll take you there as well. I'm Ira Epstein. You have a great day.